Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're discussing a significant report from the United Way Greater Toronto and the Cooperative Housing Federation of Canada that calls for a dramatic increase in funding for co-op and non-profit housing to address Ontario's housing crisis.
That's right, Steve. The report, titled Built for Good, highlights the need for $62.6 billion in investment and subsidies by 2030 to scale up co-op and nonprofit housing. It's a bold call to action, but it seems necessary given the current situation.
Heather McDonald, the president and CEO of United Way Greater Toronto, emphasized that the current approach isn't working and a large-scale intervention is needed. According to her, without this kind of investment, many Ontarians, especially those with lower incomes, will be left behind.
It's heartbreaking to think about the number of people who might not have access to affordable housing. The report outlines a need for 805,000 deeply affordable units for low-income households, including 255,000 new nonprofit and co-op units. It also mentions the need for 145,000 moderately affordable units, with a portion allocated specifically for Indigenous households.
The numbers are staggering, Janine. The report suggests that over half of these deeply affordable units are needed in the Greater Toronto area. Simone Swale from the Cooperative Housing Federation of Canada pointed out that co-ops don't turn a profit, which makes them more affordable since decisions about rent and maintenance are made collectively by members.
And it's not just about building new units. The report also calls for acquiring, repairing, and maintaining 225,000 more housing units to prevent the further loss of affordable options. It's about preserving what we have while also expanding.
Absolutely. McDonald mentioned that investment is needed from all levels of government, with a particular opportunity for the province to take a leading role. She sees affordable housing as a critical component of the province's infrastructure, crucial for preventing increased spending on shelters and emergency care.
It's a holistic approach to a deep-rooted problem. By addressing housing, we can alleviate pressure on other social services. It's about catching up on decades of underinvestment.
Exactly, Janine. With the private sector's current projects not meeting affordability needs, there's a clear opportunity here for co-ops and nonprofits to fill the gap. Especially now, with the condo market experiencing a downturn and developers canceling projects, the timing seems right for a shift toward more sustainable housing solutions.
It's about seizing the moment, Steve. As Simone Swale noted, the need in communities is greater than ever, and this could be a pivotal moment for making significant strides in affordable housing.
Let's move on to some promising news for renters across Canada. Recent data from the Royal Bank of Canada indicates that rental prices are finally easing in more than half of the country's major urban centers.
That's right, Steve. After years of relentless rent hikes, Canadian tenants are seeing some much-needed relief. Cities like Vancouver, which recorded the steepest year-over-year drop of $270 for two-bedroom units, are leading this trend.
It's quite a shift from the post-pandemic period when rental demand was driven up by wage growth and international arrivals. During that time, over a third of Canadian metropolitan areas saw annual rent increases of at least 20%.
Those were indeed challenging times for renters. The affordability crisis reached a peak with vacancy rates plummeting to a record low of 1.5% in 2023. It was a tough landscape with average rents for two-bedroom units increasing by 8% over the year.
Now, we're seeing a softening in the market due to several factors, including affordability constraints that limit tenants' ability to pay higher rents and a deceleration in population growth. Moreover, the increase in rental supply is giving renters more options.
It's definitely a relief for tenants who faced unprecedented pressures during the pandemic recovery. In some areas like Toronto, rents increased over 40% at the height of the crisis. The current decline in rents is helping to rebalance the dynamics between supply and demand.
While the recent moderation is welcome, we should note that the rental market remains tight in many areas. It's a step in the right direction, though, and hopefully we'll continue to see improvements in affordability for renters across Canada.
Absolutely, Steve. It's encouraging to see these changes, and I hope it brings some stability to those who have been struggling. Let's keep an eye on how this trend develops over the next few months.
Let's turn our attention to the significant real estate developments in Northern Ontario, where a massive sell-off is underway due to a major bankruptcy process. Currently, 54 out of the initial 407 residential properties involved are still awaiting sale. This process is being monitored by KSV Restructuring under the company's Creditors Arrangement Act.
It's quite a situation, Steve. The properties are spread across various northern communities, with 26 in Sault Ste. Marie, 21 in Timmins, 4 in Sudbury, and 3 in other locations. It's a reminder of how widespread the impact of such financial troubles can be, affecting not just the companies, but also the communities where these properties are located.
Indeed, Janine, the original insolvency involved 11 companies, which had accumulated debts initially reported at $144 million, later reassessed to just over $90 million. Their business model was to purchase distressed properties, renovate them, and rent them out. However, questionable business practices emerged during the insolvency process, which contributed to their financial downfall.
It's disheartening to see how these practices can lead to such significant consequences. The companies were found to have indulged in luxury purchases, trips, and large dividend payments despite not being profitable. This kind of mismanagement has ripple effects, especially when properties are involved.
The secured creditors, primarily those holding first mortgages, took ownership of 323 properties last year. The remaining 54 properties, which represent 80 units, are being sold on the open market. However, to prevent flooding the market, new listings are only added as others are sold. So far, 32 properties have been liquidated, generating approximately $3.3 million in net sale proceeds.
It's a careful balancing act to ensure the market isn't overwhelmed while also trying to maximize returns from these sales. It's worth noting that 39 of these units are currently unoccupied, which might make them more appealing to potential buyers looking for immediate occupancy options.
The legal side of things is also progressing, with KSV having received court approval for Viscount Capital to handle the core claim involving 9 of the corporations. This is part of the ongoing efforts to recover more funds for the creditors involved. The court has also extended the stay period for the CCAA process to January 31st, 2026, allowing more time to sort these matters out.
It's a complex process, but it's crucial for the creditors involved to recover as much as possible. Hopefully, with Viscount Capital taking over the legal claims, there might be a better chance of recouping losses and addressing the financial impacts on the communities affected.
Let's turn our attention to the currency market and its impact on the real estate and mortgage sectors. This week, the Canadian dollar, or loonie, has seen a decline, trading 0.2% lower at 1.3784 per US dollar. This comes as the US dollar strengthens ahead of some significant economic data releases in the United States.
That's right, Steve. The anticipation around the U.S. Consumer Price Index data is high, as it will likely influence the Federal Reserve's decision on interest rates in September. A strong inflation print might keep the U.S. dollar robust, which can continue to put pressure on the loonie.
Exactly, Janine. And while the Canadian housing markets are showing some signs of recovery, with cities like Toronto and Vancouver seeing upticks in home sales, the broader economic context remains challenging. The potential for a Bank of Canada interest rate cut is increasing, especially after recent data showed a loss of 40,800 jobs in July.
It's a tough situation for the Canadian economy. The backdrop of elevated U.S. tariffs on Canadian goods, despite exemptions for certain items, is making it hard for our export-reliant economy. But, as always, Canadians are resilient. A recent Bank of Montreal report even highlights that Canadian households are spending steadily enough to cushion some of the impacts on business investment and exports.
True, Janine. And while oil prices have seen a modest recovery, rising to $64.18 a barrel, the overall sentiment is cautious. Canadian government bond yields have edged lower, indicating market expectations of an economic slowdown.
It's going to be interesting to see how these dynamics play out, especially with the looming deadline for US-China tariff negotiations and the potential impact on global markets. The Canadian dollar's performance will be something to watch closely in the coming weeks.
Absolutely, Janine. These economic indicators are crucial for anyone involved in real estate or mortgages, as they have direct implications on interest rates and borrowing costs. It's vital to stay informed and ready to adapt to these changes. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.